Good afternoon, everyone, and welcome to our second webinar in our series. Today, we're focused on building a path to profitability through digitized investment vehicles. Creating new business ideas and getting to market as quickly as possible is challenging, and especially in a rather competitive environment. Managing your investment strategies and deal flow should be seamless, easily manageable, and scalable. So in today's 45-minute webinar, we're going to cover key considerations to address when setting up your investment vehicles. I'm Alex Green, one of the co-founders and chief evangelist at Globacap. At Globacap, we've digitized and automated the underlying processes behind private capital, which enables a suite of tools to help you better engage and manage your investor network. Alongside myself today, we have an expert panel, including Christopher Tremaine. He's CEO of Kimura Group, and Peter Stransky, who is a partner at IDAP Global. So thank you both gentlemen for your time today. We really appreciate it and look forward to the conversation. Christopher, if you wouldn't mind kicking off and introducing yourself, please.
Hello, I'm Christopher Tremaine. I'm the Chief Executive of Kimura. Our principal activity is in the private credit markets. We have developed the group globally now, focusing on debt capital finance in the commodity markets. There's a nice slide up there showing some of our headline statistics. Over the last 7 years, we've pulled together a $20 billion loan portfolio, active in 37 different countries, amounting in more than 5,000 individual transactions. We primarily focus on energy, metals, and agricultural companies, purely from a debt perspective. That's one of our core strategy, which is our mature business. My background is in commodities and commodity trading, where I have 25 years experience. I spent 15 years as an energy trader at tier 1 investment banks, hedge funds, and I was global head of commodities at TPG, the private equity group in London and New York.
Great, thank you very much, Christopher. And Peter, would you mind please then introducing IDAP?
Sure, thanks for having me. And at IDAP, we are focusing at bringing effectively new liquidity into SME growth capital requirements in 2 buckets. One, which we consider really exciting, is digitized real-world assets, which are tradable across multiple different categories. As you can see, can be from the aircrafts, greenhouses, but also show jumping horses, contracts for Brazil nuts, and so on and so forth. And on the other side, syndicated financing for mostly smaller deals in M&A buyout, but also investment financing. We are around only for quite a while, so we don't have yet impressive statistics as Kimura Group, but we're heading in that direction. And my background is over 25 years building, growing, and restructuring mostly tech businesses and venturing into the fintech space in the last couple of years.
Excellent, thank you very much. So at Globacap, we are a private capital markets ecosystem. We have software tools that allow our users to manage everything from placements through to registry and issuance of securities and assets in a digital capacity. And then we also provide for the transferability of those instruments on platform. So far, since inception, we now have $14 billion worth of private securities that are using our digital registry. We've executed over 40 private placements for our clients, and there has been $180 million of transaction volume completed in our secondary facility. We currently have 11 white labels out to institutional players across the globe. We are authorized by the SCA as an arranger of investments and transactions, and also carry a CAS authorization, so we're a custodian. We have now over 60 employees, and we were founded back in 2017. Thank you very much for Chris and Peter again for attending the webinar. I think let's just start the topic of, what do you guys look for? What do you account for when you're setting up your investment structures and managing your business? Are we looking at regulatory compliance? Are you thinking about like managing multiple jurisdictions? Is it types of investors, the quantity of investors? So why don't we start off with you, Chris, first, and you can just give your kind of color on the topic.
Yeah, I mean, that's always when you're starting out business, it's always a poignant issue and a very difficult one to actually find the best solution for, because ultimately, in terms of jurisdiction and regulation, you're driven by your investors' requests and their demands. Are most of your investors going to come from the United States? Are they going to come from mainland Europe, the UK, or Middle East, Asia, and so on? And typically, managers try to go for some kind of, or advise to go for some kind of best fit overall solution, which tends to be something like Cayman, which then comes with a whole series of problems, again, about selling investor products that are offshore Cayman into Europe and so on. So it is quite a difficult process to go through, and indeed you tend to get a lot of conflicting advice when you set out, but ultimately you have to be driven by what your early stage investors or what jurisdictions they're coming from. So that's something to be very mindful of. I mean, but the issue is that it's quite a minefield in terms of actually centering on one solution or one piece of advice where you can have a best fit. And indeed, unless you're a large scale manager, it's very, very difficult to actually be able to achieve that best fit status and collect the most opportunity globally without breaching any regulatory boundaries that you may come up against. So that was very much a challenge for us when we started. We thought that all our investors were going to come from the United States. I think today, I think we've got maybe 2 investors from the US and everything else is rest of world. So the solution that we thought we were delivering for our investors actually caused us to come in to have to take evasive maneuvers and do all kinds of other structuring around it to actually then let or make the investment available for the broader array of investors that we did actually end up with. So it's quite a difficult process, and as I said, it's no real solution when we started offered comprehensive regulatory coverage. We ended up in our early stages partnering up with a large investment fund because we were being faced with all these challenges early on, and for us, we felt that was the solution. And that relationship wasn't a great one. And we ended up returning independent, but it is a very tricky thing when you first start your business.
Excellent. Yeah. Well, thanks, Chris. And I'd like to come back to some of those points that you brought up here and ask some questions. But Peter, if you want to perhaps shed your views on the topic as well.
Yeah, in our case, the structuring was one of the key aspects. So looking at where we want to predominantly issue our products, and that's because of I think our laser focus on those digitized assets and syndicated deals. That part of that is that our aspiration was to create quite some level of standardization across completely different type of the deals. And so our decision making was driven by that, and we settled on using securitization through Luxembourg as our main vehicle. I think it's fair to say that even in the hindsight, it was a good decision. So that's, I think that's pretty good. Also from the perspective of Luxembourg regulator being a pretty proactive in good sense, not SEC proactive. And trying to rather have more futuristic point of view. And I think that's what there's one quite interesting aspect which we're seeing, and we don't know to what degree actually that aspect will stay, which is feeders vehicles, because we thought in the beginning that we will have to be setting up, especially for the US feeders vehicles, because of various reasons. But it seems we can actually avoid that. We've been able to go with relatively universal structure across multiple type of the investors. Now, there are always limitations. I mean, just said to what Chris said, in reality, it's more looking where you do least compromises than anything else. And then, of course, in our case, as we were starting recently with complete focus on digitizing everything, that was also another aspect which is quite interesting, meaning where regulators will be fine with registers being in digital and being more like in cloud and somewhere in the office of the fund admin, or in our case domiciliation agent, and where they will be fine with digitized KYC. So there was, even though that's probably a topic to discuss later, but there was important aspect as well. So it's not only structuring from, okay, what legally and in compliance way will allow us to solicit investors across the world, but also, okay, where we can actually have the support for full digitization of the processes around our vehicles. So it was also important consideration.
Great, thanks. I think that goes into the next slide quite well here. So, when we talk about the importance of structuring investments, so maybe Peter, you can continue in that thought that you started off there, where you're talking about securitization as a strategy, right? And the standardization. So, I think you obviously trying to meet different needs, and then we can go back to Chris and get his views as well. Same.
Yeah, in reality, so we bringing what you can consider new. Not that securitization is new, but we're using it for a new type of a product, and that's also where standardization is very critical, because it takes us some time to explain to investors, but also to our partners, because it's probably fair to say that's part of the structuring as well. We are building the infrastructure where we have partners in various jurisdictions, which means placement agents, dealer brokers with authorizations, to be able to solicit investors. But it's not only about the initial placement, but also about, and that's coming back of the structuring, about secondary trades. So one of the important aspects, and that's one of the reasons why we chose securitization as a strategy, is, okay, well, one thing is getting that primary placement, but how to make it attractive? Well, you can make it attractive if I, as the initial investor, can actually trade out at any point. And then, of course, any point means there needs to be someone who wants to buy, but at least from a perspective that trading that instrument, which is representing the underlying, but at the same time underlying might not have that liquidity, is becoming liquid and frictionless as possible. There was a very important aspect for us, which also involved, okay, how to make sure that we can work from the beginning across multiple jurisdictions with least additional burden of compliance issues, which you can read like, oh, how to make sure we can have just one PPM and one subscription agreement, and we don't have to have different ones in different jurisdictions. And so far, it seems we achieved that, and that goes to digitization and standardization and cost.
So a lot of this is about streamlining the costs and keeping it simple and trying to lower those, compress them as much as possible. So you're trying to go through this one solution fits all strategy with the standardization, where I think Chris at the stage where he is, maybe started thinking that he'd go that way, and that didn't work out. So both of you have touched on a really important point, like flexibility, I think is a theme that's come up here, and you need to be flexible. You need to be able to pivot, but also flexible and, okay, I'm going to go with one structure. No, that's not going to work. I need 3 different structures. So, Chris, maybe you can talk about that, the flexibility and.
Yeah, I think private markets and alternatives offer the greatest alpha generation opportunity on a risk-adjusted basis of our generation. But one of the major issues is access to those private markets. When a typical investor, these kind of, especially from a debt perspective, these kind of things look funny. They're not standardized. They don't have a well-defined settlement procedure. Obviously, Peter's business doing securitizations is something that solves for standardizing that kind of time frame and settlement procedure. But that is the industry should be far larger than it is, because it certainly offers more consistent risk-adjusted returns across the spectrum than you get from other more traditional markets. But the access to those markets are really the barrier. Regulation, standardization, the ability of an allocator to understand, well, how the hell do I settle this in my portfolio when I want to get out? All of these are major issues. And if you look at global trade, it's in terms of the size of the market, it's a $14 trillion industry. And there is, an enormous gap in liquidity in the market. It should be, as a standardized asset class, the same size as global equities and indeed bonds. But it's not, because it's the access to actually getting into those markets because of the non-standardization that creates the barrier. So you can then, as a manager, structure something up like a fund as a commingled share scheme, but then when you engage with some of the world's biggest investors, they can't actually invest in commingled share schemes. So then you've created another barrier for yourself. So you get a whole bunch of co-investment where you have to spend a huge amount of time educating people so that they can sit in risk pari passu to you. But really, we want to build for a solution which democratizes the whole private markets alternative asset class, where we can create some standardization, and then proliferate these markets with much needed liquidity, which is good for global economies, but also offers up investors stable, scalable, uncorrelated and defensive returns over the long time.
Great, thanks very much. And I think the next segment, the different approaches and strategies to structuring, and we can continue here on these themes that we're touching on. Now, when you're talking about that access and the transferability, and yeah, maybe Chris, you can start with. You have multiple strategies. Do you need to automate all of those components? So like you just talked about, okay, so if you want to engage with the people that have the commingled share schemes, fine, there's a certain group of individuals that can, but then when you go to the larger players in the world, you can't. So maybe you don't have, do you ever think about perhaps streamlining or automating components of that aspect to actually then improve efficiency? So how much are you guys looking here from like efficiency, workflow compression tool, and then how that helps you then engage and provide that access that you were talking about, Chris?
End to end, it's an incredibly laborious process, and it's incredibly admin heavy. And I give an example of one of the smaller businesses which we recently launched, which is a sports and esports organic venture capital business. As you know, Alex, you got to wear some of the pain from me when I told you how much work that I had to put into that process, just on a simple limited company offering out to 35 friends and family investors, with shareholders agreements and filings with Companies House and the issuance of additional shares. And I mean, literally, it was like starting Kimura all over again. It was 5 a.m.s till 1 a.m.s every day. That was incredibly admin rich and heavy, and migrating across that small business to Global Cap's platform completely streamlined that process. And I kind of kicking myself thinking, oh, Chris, you're an idiot. Why the hell didn't you do that before going through this world of pain that you did? So even from smaller scale investment that when we approached it, we thought was going to be quite simplistic, was a complete administrative world of pain. Just end to end, just with UK domiciled investors going into a UK limited company. Then you go to the other end of our scale in our mature businesses, where we take in hundreds of millions of dollars. Again, the whole onboarding process, even at an institutional level, is ridiculously burdensome. The back and forth of various documents, the different drop boxes that you're setting up, the analysis of that data, and then indeed the ultimate subscription, and then the distribution of that capital into the vehicle, is something that absolutely needs to be solved for with a tech solution, and streamlining that entire process. 50% of our staff are focused on administration. Probably more, actually, probably more like 60% of our staff are purely focused on this administrative process. And then to add to that, you've got all the third-party staff that you have to engage at fund admin, at clearing, prime brokerage, banking, external legal. It's an incredibly disjointed process. And the consolidation and optimization of that end-to-end is critical.
Thanks, Chris. And yeah, so it's nice to see that you're using digitization strategies from that small scale, like you talked about, direct SPV, where you can create 100% automation, or let's call it 90%, because there's never 100% automation in anything. But then, at the Kimura fund level, you could potentially do away with a good 30%, so it's still cost savings and times, and then we look to get to the 100%. So that's interesting. We can come back to that in the emerging trend section of where things are going. But now, Peter, you have a very specific strategy, and it's unique, and you have a unique platform. Maybe you could talk to your approach and the why, but also what automation or what the digital platform has allowed you to do. Because when Chris talked about 60% of his staff, I know you're a rather lean group. So how much of your workforce, of that administrative staff, is the platform, or what has the platform allowed you to do?
So in our case, we've so far been able to also outsource quite a lot of admin stuff. So that means we don't have to do so much internally. I mean, as we will be growing, we will have to, because there is one level of complexity which we haven't digitized yet, and we have to, which is underlying structuring, because that's more bespoke. So for each deal, there is a level of structuring which needs to be done in order us to be able to securitize, and that's why actually it's pretty laborious process with a lot of complexity. But that's why I think we will be able to do 50%, because it's then jurisdictional specific. Now, when it comes the front end or the actual product, that's where I think we already achieved something like 60–70%. If not full digitization, it's at least repeatability. So we've been able to template many things to a large degree, so that with new project, we don't have to start from scratch. For example, with PPM, we don't have to start from scratch with subscription documents. And of course, where there's a quite interesting aspect, which I'm not too sure whether you will want to cover more in detail, so I will mention it here. So one interesting hurdle which we haven't anticipated when we were starting with digitization, we've seen, well, we'll be able to be efficient, our investors will be able to be efficient, our partners. Well, that's true, but at the same time, there's a hurdle, because we need to get them used to actually use digital platform, because they're not necessarily used to that. Especially institutional investors are still like, oh, okay, well, there's either Dropbox or sending things over the email, and there is an educational path where I think all the key players in the market will have to actually overcome. I think it's more behavioral, to be honest. I don't think it has anything to do with anything else. It's just used to it. Oh, send me PPM. I say, well, it's on the platform. I mean, that's where you have it. So this will be interesting journey, and I think it will come. And what we really excited about is the possibilities we have with integrations with the third-party social, because it's another aspect which is still in the private markets. You have multiple players doing their own pieces, but actually there's a little integration to actually be able to leverage all those pieces. And that's definitely our intention, to leverage our core piece, which we have, and be able to integrate and leverage the pieces which do exist in the market. So yeah, that's why I think we've been able to so far match, and that's coming what Chris was saying. There's this thing. You, of course, at the end are driven by the regulation and also by legislation of the specific jurisdiction where you're doing the issuance. And that's why we've spent, actually, to be honest, good 9 to 12 months talking to multiple advisors in multiple jurisdictions before we set out on Luxembourg securitization. And because we were looking for specific aspects which we needed to be fulfilled. And we talked, even in Luxembourg, it wasn't that easy. We had some conversations which were very interesting, which were effectively driving us into, oh no, let's use, the traditional Eurostream, Clearstream, standardized things through private banks. We said, well, we don't want to do that for many reasons. So well, it was quite an interesting journey, and I think that anyone who is looking to, I think it's really important to set up what are you looking for. And as Chris said earlier, I think what is the worst be driven by advisors. Not because they have an agenda, but what we found, they have limited point of view, which is mostly very centric on problems they're solving, which, oh, we need to be compliant, whatever. And it's actually secondary. You want to be compliant, but you want to have the structure which is serving your commercial purpose to start with.
Well, yeah, well, thank you very much. And let's segue that into the next, the emerging trends, because I know Chris has, we had a conversation earlier in the week, and you have some views around this, around the third parties and the processes that they tried to guide you down. But then I think, we are having a conversation where you're saying, yeah, it doesn't, law firm doesn't matter. It doesn't matter who you're using or what you're using. The investor in the end cares about the investment opportunity in the vehicle. So if you can present them to them. So maybe you could touch on that, on just your views real quickly on those traditional players in the market and where you get steered down. Then also the last point about what investors really care about. So that investor education piece, it is a pain point, but do you think that that's easily overcome? Because if they're shown a good opportunity, are they gonna buy it?
The cost of setting up a manager is quite aggressive, and the cost of running a small boutique or growing to a mid-sized manager investment business is very high as well. But they're kind of loaded for failure from the beginning. I believe the statistics are something like 15% or so managers only make it into year 5. And a lot of that comes down to when they have lean times, the huge burdensome costs that they have, or perhaps the inflexibility that they have within the governance structure stops them from being able to receive capital from different avenues. And you see it every year. I mean, there's one particularly large conference, I won't name any names, but when you attended, full of hope as a wide-eyed budding asset manager, and all the usual characters are there from the law firms and the big 4 auditors and so on, licking their lips, ready to pick up your business, which of course they have fairly standardized advice, because you're a small scale or a startup manager. So inherently they don't really want to spend too much time on you, especially with the massive fallout rate that the industry has. So what you get is sort of a predetermined structure advice pack, which comes at an incredibly high price, and all because you're constantly told that if you don't have Big 4 auditor, if you don't have a Golden Circle law firm, if you don't have a top 10 global admin, you will get no investment at all. Now, I suppose if you make it to the point where you can receive money from endowments and pension schemes, when indeed you break through that glass ceiling, which ironically is actually beyond 5 years of track record typically. So it's kind of funny that fallout rate is so high, and therefore the endowments and pension schemes and the consultants that advise them only really invest in them after 5 years. But at that stage, then they really care about the blue chip governance structure and how you have solved for it. But certainly in the early stages, or the advice that we were given, and spent considerable sums of money, which nearly was the end of me getting the business going, turned out to not really be correct. The investors they knew that they were investing in a startup. They cared. What they cared more about was where the total expense ratio was of the product that they were investing in. So it's all well and good that you've got a Big 4 auditor or Golden Circle law firm or top 10 fund admin, but if you had solved for that and used a disruptive piece of technology, which we would have found perfectly sensible and perfectly appropriate for a family office to invest in us, because they know they're investing in an early stage manager and they're fully aware of all the risks that go along with that. The service that you get by looking at much more streamlined and disruptive technology, I believe, is much better than going to a very large company when you're very early stage, because those companies realize that it's likely that your business is going to fail. So you get standardized advice, standardized documentation, and no real care through the process, and you're charged top dollar for it. So that is one of the many obstacles that the industry has, and I think the industry is geared up in such a way that, of course, as a new fund manager, you're very proud and probably coming out of a big institution, and you're used to being wrapped in the cotton wool that these big corporations give you by association with their name. Investors really want the maximum alpha in investing in an early stage business, and the focus on reducing TER to its absolute maximum, streamlining the process, is far more appealing in that early stage investment than having all these blue chip names who aren't really giving you any advice or any support. Once you, all of a sudden, once you become a mid to large scale manager and you start getting pension fund money, endowments, insurance company money, you start getting on the remit of the consultants, then I would say that probably having the larger firms involved is sometimes a good thing. But again, that's when you're really paying for it.
Okay, great, thanks. So I guess you're one of the trends, or one of the things you're definitely supportive of and highlighting, is a move towards more automation and cost-conscious behavior, which I think the entire investment community obviously is focused on, that cost-conscious behavior and fee compression. Peter, any trends that you've been seeing? And then I'd also like you both to touch on the transferability trend. So I know, Peter, you talked about how that was built in from day one to the structure of your product. And then Chris, maybe you could touch on transferability and how you would approach that if you could integrate that seamless transferability or secondary transfers, let's call it, within your investor community.
So just one point on the cost. I mean, in our case, we were looking at how to be cost efficient from the get-go, and we had the luxury of being able to set up a structure which is lean from the get-go. And I think it's critical because that's a trend. But also in our cases, we deal with the underlying projects from, let's call it 5 million up to a couple of hundreds million. And of course, on the lower scale, the cost efficiency is the key, because without it, it will never actually provide any alpha, which because all will be eaten by cost. But it's actually also critical for the larger ones, but actually really optimizing for it, because mostly that's where the cash yield, and we're focusing a lot on the cash yield products. You want to maximize it, so that means that's where the efficiency is critical. And that's one of the trends we're seeing, that it's being appreciated if you actually proactively going in that direction. So instead of kind of slightly building up on what Chris said, which is, well, okay, it's great that you have all the structure which you need to have, but then what is that underlying productive asset, and what it does, and what risks are associated with it, of course. Because structure serves only that. I mean, we don't create the yield for the investors because of a structure. We create it because of finding actually good assets. The structure is there to actually optimize. If you think about it, it's almost like a gearbox, right? It's optimize the transfer of the money in and the money out. That's really what it is for. And then yes, of course, create protection covenants in order to make sure that all the risks are mitigated to the degree it can. And that goes then to the fact that what we're seeing from some large institutions we're talking to on a more partnership level is quite a desire to explore new products where you can bring them in a form which is, let's say, have a level of familiarity, meaning right jurisdiction, which is tested. It is something what is understood. So for example, we're using a lot of profit participating notes, but at the same time, it has some novelty in the way how you transfer that yield which is generated in the underlying asset to the investor. And this goes back to the tradability, because that actually creates all plethora of the possibilities if you do it in a way which allows then investors or third parties being able to build it in additional products, because it's structured properly. That's actually almost like you turbocharge your products and allow them to go into the distribution channels which wouldn't be interested otherwise.
Great, thanks. Chris, what are your comments then on
Yeah, transferability in what we do in private markets, great. Allows you to give broader access to a wider array of participant investors in the products. I mean, we do a lot of bilateral risk participation and sell downs of the risk in the book to create more diversification and also give investors the opportunity to have a completely bespoke risk solution without having to create new share classes, etc. But still, that is a bilateral activity. So you're agreeing typically on BAFT documentation, like a master risk participation agreement, which effectively gives you like a co-invest structure. But creating a digitization where you can offer up the portfolio as a series of syndicated securities that are standardized, that investors can come in and pull up your live portfolio, and without really even you interacting with them, can say, okay, I want to buy that risk, I want to buy that risk, I want to buy that risk, and then that is returned to the portfolio manager and just drops into his portfolio. So that would be, you know, a very elegant solution for what we do across all of our loan portfolios.
What's success look for for both of you and for your institution and for your clients as you scale? You know, maybe Chris here. So, you know, where are you now? Where are you looking to get to in terms of your structure and using platforms as well as you scale?
In our main asset class, there's a huge liquidity gap in the market, and I'm sure you're painfully aware of institutions constantly bleating on about liquidity, supply chain issues, so on. The legislation has driven a lot of the typical liquidity out of the market, investment banks and so on. Wonderful pieces of legislation like the Basel Directive, MiFID, Volcker, Dodd-Frank, and all that good stuff. So that in itself has created a huge liquidity squeeze on the market, which now needs to be filled with other sources of capital. Sources of capital from alternative managers, from investments, from insurance companies, and so on, that are not beholden to the bite of Solvency II, Basel, and so on. So it presents a huge opportunity, and there's there's very few providers out there. But you know, in order to grow in the asset class that we're currently in, as I mentioned at the start, one of the earlier questions, we have to carry a large headcount in terms of administrative burden, and to scale substantially, that administrative burden is carried across. So we do constantly look for optimization and solutions, but that is really for us the limiting factor in terms of scale, is the fact that the industry is archaic and quite Luddite in terms of its approach to digitization, and that's comprehensive. I mean, there are other things to consider, that, you know, the supply chain tends to come from emerging economies and is consumed by developed economies. So, you know, you may have a high degree of illiteracy in, say, point of origin, and certainly no computers. I mean, in some cases, there's, you know, power's not on 24 hours a day. So there are some things that you're not going to be able to solve for with a neat tech solution comprehensively all in one go. But for us to really scale and continue to scale, we have to utilize administrative optimization, offer products that are more standardized to our investors, that don't cause regulatory blockages, that can be distributed globally, that are easy to understand, and straightforward, and can be processed on an automated basis rather than having 20 humans getting in the way of one single subscription or one single redemption. So that's really our limiting factor. I hopefully, you know, based on our past performance and the future horizon ahead of us, we'll still be here in another 5 years or even 10 years time, continuing to provide much needed liquidity to the global economy that is fast drying up.
Thanks for that, Chris. Peter, I'll pose the same question to you. I'd love to get your views on that, on success for your business, where it is now, and where you think it's going to go, and where the industry needs to go.
So I would even say that in our case, it's success of the of almost new asset class, even though it depends how we look at it, because it's alternatives, easy assets. But the way we're looking at it, we're really digitizing the real world assets with some productive function and therefore yield. So we can almost equal our success to success of that category. And the way how that we believe that category will succeed if actually they'll start to a degree almost replace within this 60-40 corporate bonds, because we think that and not replace necessarily corporate bonds on the top of the market, but where actually corporate bonds you can use, because these are smaller companies with no ratings or mid-sized companies. So you would rather want to finance the asset and not take the operational risk, because let's face it, I mean, you can't even count those or evaluate those operational risks properly. So point is that we want to enable that so that hundreds of billions of those assets can be financed and made effectively liquid, and that will bring that liquidity to those companies to be able to grow and generate that yield, but also to the investors effectively new financial instruments which they will be able to understand, they will be able to evaluate the risk, and they will start including in their portfolio. So if we achieve within the next 10 years that, let's say, something like 5% of traditional portfolios will be this type of the asset, that's what I would call success. And this can't be done without quite a high level of integration. So it means digitization integration between various players in private markets. And that will be quite exciting, and that's important part of that. So that means KYC, KYBs, which are more distributed. That means redemptions, the coupon payments, which actually can go across multiple players, but without centralized players like Eurostream or Clearstream and so on and so forth. We trying to make happen. That will mean that we've been successful in what we're doing.
Thank you to both. I think we're here at the end of the 45 minutes now. So yeah, it's nice to get your guys' views. It's about optimization, cost compression, but then also that flexibility. And I think it seems like you both want to get to standardization, so then you can actually just execute more deal flow and more volume through both your respective platforms. So thank you very much again for your time, Chris and Peter. And yeah, look forward to continuing to work together.